from an exotic flower to a symbol of social status, the basis of a speculative frenzy, and the perfect representation of a pattern that would repeat itself constantly throughout history, in an economic and psychological phenomenon that humans seem unable to escape: financial bubbles. In the 1630s, Holland experienced a golden age characterized by a period of great economic prosperity, being one of the main commercial and financial centers of Europe, and a society strongly influenced by Calvinism, where moderation and sobriety were highly valued, and ostentatious luxury was considered a sin and a show of vanity. But despite the fact that ostentation was not well regarded, social position was extremely important in Dutch society at the time, and people sought to demonstrate their wealth by acquiring objects related to art, silver, and other collectibles, but none of these objects had the same impact as the protagonist of our story: tulips. Tulips are flowers native to Central Asia that arrived in Holland in the 16th century through the silk trade route. Being part of nature, their initial fame was not frowned upon by the strictest people in society, and these flowers gradually gained great appreciation and space in the country's culture. With this appreciation came an increase in price and interest in the different types of tulips, where growers were willing to pay increasingly higher prices for the flower bulbs, attracting the attention of speculators. These transactions were carried out in informal markets known as colleges and taverns, where the parties reached a purchase agreement. Those who planted the bulbs bought them through the spot market from June to September, while speculators traded them throughout the year through contracts, where a person committed to buying a tulip bulb at a set price today, and for this right, delivered a sum of money or premium, similarly to what happens with modern financial options. Thanks to the rising price of tulips, these contracts gained value quickly, incentivizing people to leverage themselves. Because since they only needed a portion of the money, they could enter into many contracts with the intention of selling them later at higher prices, causing the price of tulips to accelerate, and going from an interest in them as a status symbol to a gold fever for all the money that could be made through these operations. In February of 1634, a sale of 100 tulip bulbs was recorded for 5,500 florins. By February of 1637, just before the market collapse, a single tulip bulb of the same species was sold for 12,000 florins, an increase of 21,718% in the price of tulips. For reference, a medium-sized house in Amsterdam cost around 3,000 florins. This caused more people to get involved in the market, and the cultivation of these flowers increased considerably. But like any bubble, eventually the demand dried up and prices began to fall in February of 1637. By the end of the year, prices had returned to levels similar to those seen earlier in the decade. Oversupply is believed to have been one of the triggers for the price collapse, as well as a loss of interest in tulips. As a result, contracts lost value and wealth that existed only on paper disappeared in a matter of weeks. A lot of these contracts had to be settled through arbitration at an average of 3.5% to 10% of the initially agreed upon value. The losses affected producers, speculators, and traders, but contrary to popular belief, did not cause a depression or economic crisis in Holland. As a historical event that occurred almost 400 years ago, the tulip bubble has generated some disagreements regarding its exact nature, and many of the figures and effects it had on Dutch society may have been greatly exaggerated. This may be due to the fact that one of the main works that documented this event was Charles Mackay's book, Extraordinary Popular Delusions and the Madness of Crowds, which is where most economists and market analysts learn about the tulip bubble, and which has also been a source for documentaries and references in films such as Wall Street 2, for example. However, Mackay's book was written in 1841, more than 200 years after the events, and was based mainly on pamphlets published during the time by Calvinist groups that opposed speculation and the acquisition of wealth without work. Therefore, there is a clear bias in the narrative it presents, making everything that happened with tulips seem like a major crisis that could have destroyed Dutch society. But modern historians, such as Goldgar, who wrote the book Tulip Mania, Money, Honor, and Knowledge in the Dutch Golden Age, have reported that there were no records of bankruptcies or an economic crisis resulting from the bursting of the tulip bubble, and that contrary to popular belief, only a portion of the population participated in this frenzy, and in the end, the biggest affected parties were tulip producers, who nonetheless were still able to produce and export the flower to other countries. However, the lack of serious consequences for the economy does not mean that tulip mania is an event to be ignored. On the contrary, its components continue to repeat themselves again and again in different countries and situations, serving as a perfect representation of the phenomenon known as financial bubbles. Financial bubbles, or economic bubbles, are phenomena that occur when the price of an asset departs from its fair value, with this definition being very indicative of the subjective nature of this phenomenon. Firstly, because the fair value of an asset is subjective. Secondly, because in times of optimism it is normal for the price to be above that value, while in times of pessimism it is below. And therefore it makes it very difficult to define when a market, stock, commodity, currency, cryptocurrency, or real estate property are overvalued and are at a level where they can be called bubbles. And it is normal for technology companies, as has been the case with Amazon, Google, or Tesla, to have excessively high prices for their financial results, but then these have improved at a much faster rate than the price increase and have become more reasonable without the need for a pronounced drop in price. Although a situation in the market where prices have gone out of control can be called a bubble, it is only when it bursts that it is possible to confirm that it was one, and even then there is often no absolute consensus. However, these are considered some of the biggest bubbles in history. In 1840, England experienced a period of great investment in new railway lines, which led to the emergence of dozens of new companies and attracted the interest of entrepreneurs, traders, and investors, driven by the promises of great profitability in the sector. This caused railway company stocks to skyrocket on the London Stock Exchange, despite being established without a solid business plan or clear construction plan, and also caused a large number of unprofitable and impractical railway lines to be built. But when these companies began to fail, the bubble burst, with significant economic consequences for the country, with the closure of many companies, an increase in unemployment, and also generating public distrust in the stock market. The rise of personal computers, software, and the internet led to a rapid increase in stock prices during the 90s, with the Nasdaq multiplying by more than 10. And once again, the process of previous bubbles would be repeated. Genuine interest in the underlying products or technologies would turn into a speculative frenzy in which people bought everything they believed they could sell later for a higher price. And in the case of the dot-com bubble, these purchases focused on anything related to technology, and there was a boom in companies that reached valuations of hundreds of millions of dollars without generating profits, cash flow, or, in some cases, even revenues. And although some people look at the dot-com bubble and focus on Amazon, Microsoft, and Apple, the reality is that most people who invested at this time lost money and most companies disappeared, with the Nasdaq taking 15 years to reach historic highs again. A few years later, another bubble would burst, and it became the biggest economic crisis in the world since the Great Depression. The housing bubble was formed by an excess of cheap credit and money in the economy that allowed people to buy homes without the slightest net worth or income to meet payments. With the S&P Case-Shiller Index increasing more than 80% in 6 years and also creating a market from the mortgages on those homes, which amplified the problem to several times the size of the real estate market in the United States. There was also a wealth effect. As property prices rose, people saw the value of their assets increase, giving them the feeling of having more money available. This effect encouraged people to spend more, even if they hadn't sold their property yet and the profits were only theoretical. But when the Federal Reserve began raising interest rates, and the periods where people paid virtually nothing in exchange for their homes began to expire, foreclosures skyrocketed, and the S&P Case-Shiller Index would lose almost 30% of its value, triggering a crisis worldwide. Although Bitcoin has lost over 60% of its market value since its all-time highs, and a large number of cryptocurrencies, companies, and crypto assets have disappeared in the process, it is still too early to say with certainty whether Bitcoin is a bubble, as was the clear case with assets in this ecosystem that were once worth hundreds of thousands or even millions of dollars and now no longer exist. It will be something that only time will tell, but it could not be left unmentioned in a video about bubbles, especially considering the numerous similarities it shares with the previously mentioned ones, and the psychological effects behind it that triggers these situations. Bubbles can be explained both at the macro level of society and at the micro level of people's psychology. At the macro level, these are some common characteristics that have been repeated throughout history in the different bubbles that have occurred. Firstly, wealth, which can arise from a growth boom or low interest rates that allow a lot of money to enter the economy, making it easy for people to spend money, and saving becoming unattractive, facilitating interest in risky investments. Secondly, leverage. Although initially bubbles begin to form by absorbing surplus capital from a society, it is very common for a price acceleration to occur thanks to leverage, either through contracts, low-interest loans, or a combination of both. Thirdly, massive participation. People see others making money with investments, and immediately the market moves from experts in the field to general investors to a large number of people who had never invested before. The entry of new people accelerates price rises, and a vicious circle is formed that inflates the bubble further. At the micro level, many psychological biases can be seen that facilitate these events. Some of the main ones are: firstly, confirmation bias. People focus on information that confirms their hypotheses and disregard information that contradicts them. During a bubble, investors concentrate on the innovative, revolutionary, or disruptive aspects behind their investment and ignore all warning signs. Secondly, herd behavior. People tend to follow the crowd, and during a financial bubble, the crowd is buying, so people feel comfortable doing the same because so many cannot be wrong. Thirdly, fear of missing out or FOMO. This occurs when people feel that if they do not participate, they are wasting the opportunity of a lifetime and end up acting based on this fear rather than their analysis, helping to drive the price up and make more people feel it. And finally, attribution bias, where people attribute their gains to their ability to invest, rather than recognizing that they are due to the overvaluations taking place in the market, and therefore not identifying that something particular is happening. I hope you enjoyed this video and that the information in it is useful for your investment decisions. If so, you may also want to watch this video next. See you next time.